Well, a very warm welcome to all of you. Indorama Ventures reported its quarterly earnings for the second quarter for the year of 2024. Please join me in welcoming Indorama Ventures Deputy Group CEO, Mr. DK Agarwal, to run through some of the key metrics of that result. Very warm welcome to you, sir.
Thank you, Stuart, for having me.
Just to kick off some of the top lines, now the performance was relatively stable on a Q-on-Q basis, EBITDA up just 1%, but year-on-year still down 11%. What are the key drivers of that report?
Yeah, I think, Stuart, there are still some strong headwinds as well as tailwinds. We certainly see the integrated PET margins remaining quite low because of the overcapacity in China. We are hearing that Chinese are shutting down some capacity, which should help in improvement of those integrated PET margins, but they are below significant cost and people are bleeding. So this was very disappointing in the second quarter. However, volume grew 3%. We are seeing destocking coming to an end, supply chain disturbance happening again because of the geopolitical. The freight rates are going up, which normally have a lag and you should have benefit in coming quarters. We see some encouraging signs of volumes increasing in third quarter onwards. Certainly our certain businesses, Indonesia has done comparatively much better as destocking has come to an end. They reported nearly $98 million of EBITDA. We are at about $370 million since this. We have taken a lot of steps around the IVL 2.0 in the very evolving conditions. I mean, it's very sad that we have to shut down some of the two of our very important plants like in Canada and Rotterdam. But we are on track for our fixed cost reduction for 2025, nearly 160 to 170 million per annum. They will slowly start realize from Q3, Q4 as Canada shuts down from 1st September. And also on the other initiatives, we are on track. So little bit encouraging news for coming quarters, but not as good as what we wanted in the second quarter.
You talked about some elements of the business cycle in that response. You talked a bit about volumes that we're already seeing signs of recovery there. But where do we see industry spreads at the moment and going forward?
So as I was mentioning, industry spreads, PET integrated spreads were disappointingly low because normally this is a season. These are even lower than first quarter, which are not sustainable for standalone Chinese producers. Our strategy has been to protect our market because we are the domestic producers and we have been very successful, as industry for unfair dumping. Our 70% plus market is protected because of the dumping or other known trade barriers. Chinese margins are still not going to rebound the way we think because there is a still overhang of the capacity. But there are some actions being taken by the Chinese to shut down, and what we saw in the fiber also, lifestyle fiber, that there was an improvement about $30 to $40 per ton in the fiber. So, it depends how Chinese react. The Chinese economy is also subdued at present, but we do see some growth in the Chinese domestic demand. So, our strategy is during this downturn, make our cost highly competitive and make into the first quartile. So when the market rebounds, we reap the benefit. And our operating rate was 74% in 2023, and we want to gradually go up to 88% in 25-26, which basically reduces variable cost and fixed cost and improve the quality of earning.
Now, Indorama Ventures is a company of integrated businesses. Can we just turn our attention to each of the three main business segments for a second? How did they perform in the second quarter and what are their individual outlooks for the rest?
So combined PET was nearly flat. Actually, first quarter was, we had the gain of NDC because NDC we do have a campaign run, which has a $20 million additional gain because we run on campaign basis. As I was saying, second quarter, the volumes in PET were comparatively better. We think third quarter will be better for CPET because of the increased better volume, better pricing and lag volumes. Certainly, this will help in our 2025 negotiation of the contracts because the freights are increasing and now the customers are again realizing it's better to have a domestic supplier. And remember, both European and US markets are deficit, especially the chemicals. As you know, we plan to list our packaging business. Recycling slight improvements, but a lot of work is to be done. But we are in our commitment to go for 750,000 tons recycling capacity and 1.5 million by 2030, a very sustainable solution. So I'm encouraged by the CPET. Going forward, it should improve. As far as intermediate chemicals is done, unfortunately, we had a Lake Charles unplanned turnaround, which hit us $17 to $18 million. The ethylene crack margins are very strong because the gas prices in the United States has come down. So we think that third quarter will be better for intermediate chemicals with MTB doing better, and now Lake Charles are back to the operation. Fiber has done flat basically, but we see because of the lifestyle, particularly mobility is doing better. The non-woven fabrics is doing better. We see encouraging signs, and with our transformation action, third quarter, fourth quarter should improve. Indovinya, as I just mentioned, has reported much improved results with better volumes and margins. And we see this trend continuing because particularly in South America, the crop seasons starts, where the crop which will get better margin. So overall, I would say, let's keep the fingers crossed and we should see second half better.
Indeed. Well, back in March, Indorama Ventures announced its quite monumental IVL 2.0 evolved business strategy. Can you please update us on progress on that? And also, to what extent are the results of that showing up in results this year?
Yeah, so, it was a mindset change, as you know, IVL 2.0. We said we want to deleverage from 6.8 million to $4.5 billion. We have basically working capital. This quarter itself, we have 490 million release, which is 121% conversion. I'm very encouraged by that we are achieving our working capital targets. The second is the fixed cost reduction, rationalizing the assets. So we are on track on that. The two IPOs which we are talking about, Indovinya and packaging, there's a lot of work going on. We are targeting in fourth quarter 25 and first quarter 26 to list them. So deleverage is on track. On capex, we have also trimmed down for 24. So I think we are on the, and also on the succession planning. So making the management robust and also improving the quality of earnings. So I think we are on the track for what we targeted in 26. Although we'll have to see how the United States fares down with this new data which is coming in. If the interest rate comes, more interest rate cuts happen, which will help the IVL in terms of interest costs. So let's keep as we move from quarter to quarter.
Well, Mr. Agarwal, that's a wrap on the first half of 2024. Any quick and final words for the second half of this year?
Yeah, as I was saying, in summary, I would see volumes improving. Our 70% of the portfolio is towards necessity, consumer necessity. PET is a very preferred material. We see a lot of growth in virgin. Also in India, we have seen substantial growth. So I don't see any doubt about the volume growth. Margins in China, which is subject matter, it should remain stable. But we will command our premium, whatever we have. We are continuing to work on variable costs. The variable costs will be lower. Indovinya should do better. Fiber should do comparatively better. So there is no reason that second half should not be better than first half as we prepare for our 25 results. So, management is deeply focused on it.
Good. Well, Mr. Agarwal, I wish you the very best of luck for the remainder of 2024, and thank you for joining us.
Thank you very much, Stuart. Thank you.